Welcome to Premium Cashflow Real Estate Investing Podcast with Khleif. During this program, you will hear guest experts sharing their experiences, best practices, and market insights. We discuss investing in multifamily apartment complexes and how a busy professional can passively invest hassle-free in various opportunities. Your host, Khleif, owns millions of dollars of assets and has done thousands of value-add projects over 20 years now. So listen in for insights. Here's your host, Khleif.
Welcome to another edition of Premium Cashflow Podcast. Today, I have the pleasure of welcoming Khleif, and he is someone who needs no introduction. But for starters, Khleif is a legend. He's been in the business for decades, owning thousands of doors. Today, he's big in multifamily as well. He has a #1 podcast, Lifetime Cashflow for real estate investing. Over thousands and thousands of downloads. He has his mastermind. So, Rod, please give us your background and we can kick it off.
Oh, thanks, Khleif. Actually, we just broke 8 million downloads.
Wow.
On the show. Yeah, it was kind of a milestone I'm very excited about. And, it's crazy because it's funny. You want to tell God your plans, or make God laugh, tell him your plans, because that's really what this was. I never planned to have it take off the way it was. And, now I've got an incredible coaching program with hundreds of students, and I do sold out live events. Well, they used to be live in person. Now they're live stream. I had 900 people at my last live stream event, but,
Sure.
Yeah, it's a crazy world, and it's a very, very crazy world right now with everything that's happening. And
Sure.
so before we started recording, you mentioned let's talk about the pandemic and
Absolutely.
and some insights that I might have. And for those that don't know my story, in 2008 I lost $50 million. I had 800 houses, multiple apartment complexes here in Florida, and got my clock cleaned. And I was at a very low loan to value as well. And
Sure.
And what I'm sensing is how I felt in 2006 and 7, or really not so much how I felt, because it kind of caught me off guard. But I feel like we're in that same place again. I really believe we're going to have some significant pain in this country. And
Sure. Mm-hmm.
and I was just reading today in Business Week. It was on CNN or Fox or one of the channels that United is just told that they just said they're going to lay off or furlough 33,000 people.
Wow.
And that's just one little drop in the bucket, in this domestic economy. And so you can't have that many people on unemployment and not have it impact real estate, and it's going to impact real estate. Now, yes, there's going to be another stimulus package. We're recording this on July 8th, and they're talking about another stimulus package, and I'm sure they'll do one more at least before the elections.
Sure.
But after that.
And Rod, if I may, I have the similar feelings that, we went through the '08 crisis when it was, probably 1/4 of what or probably even 1/5, 1/6 of what we are going through right now. The $1 trillion stimulus that has been handed out. I mean, right now we have had so many businesses shut down, people are laid off and whatnot, right? The impact to multifamily, to across all the sectors, is without a doubt it's coming, and it's
already hit retail and office.
Absolutely.
I've got friends in retail that, and the number I'm hearing from every one of them is that 70% of their tenants are asking for rent abatement.
Sure.
And it's hit office very heavily as well already.
Absolutely. And that's where I'm going with this, Rod, is that how do you foresee? I mean, I would see that, next 2 to 3 years are going to be filled with opportunities, and it's a double-edged sword for sure, on one hand.
There's going to be some significant pain.
Sure.
And a lot of distressed assets. Even 8 weeks ago, CoStar released a report regarding CMBS loans, and they anticipated 13,000 loans going into default at that time. And that was just CMBS. That's not conforming. That's not bank loans. That's not bridge debt. And there were so many skinny deals done the last few years, deals where we'd be in best and final, and we're just scratching our heads when we see what they ultimately trade for and what somebody paid for more than we were willing to pay.
Sure.
And so we know a lot of these deals are going to come back. And I've been picking up a couple of catchphrases as it relates to opportunity, because in 2009 I was hiding under a rock because I thought I was set for life, and had I capitalized on that opportunity, I'd be on the back of my yacht right now. And
Sure.
I'm going to tell you, hit me once, shame on you. Hit me twice, then I'm to blame. And I will not miss this opportunity because it is absolutely coming.
Sure.
And so now that said, we're closing on 500 doors in the next week and a half. There are still opportunities. Okay. And one's in Cincinnati, and it's a great deal that we can break even at 65% occupied. We've got $1 million in operating reserve, just in case fund, in case, things get bad. We've got another asset in Northwest Atlanta that, around the same dynamic. It's a nicer asset, but a little less in operating reserve. But again, we can cash flow at about 68% occupied there, and it'll be an A asset when we're done. And so,
awesome.
we're still actively buying, but are there opportunities coming? You better freaking believe it. They are absolutely coming. I have my mastermind. We've got about, I think, 10 billion in assets in there now, and represented by the members. And we did a study cumulatively where we researched unemployment, and I found a fascinating statistic. This extra $600 they're giving everybody per week. I don't know how many millions of people are on it, 40 plus million people. 80% of them are actually making more money on the unemployment, 80% than they were working. Wow. And it's unsustainable. So I know that's about to run out. I know they're gonna throw some more money at this, at least $1 trillion it looks like, maybe more. But at some point that government stimulus is going to wind down and stop, and that's when the pain will really hit. There are a lot of businesses that are on the edge. A lot of these restaurants, they can't survive at 50% occupied. Sure. Even if the vaccine comes out by the first of the year, too much damage has been done. There are landlords in some of these blue states that have had very strict eviction moratoriums they're dying. I mean, they're New York is one of them. They're literally dying. And so, and so it's sad. But the catchphrases that I've been using are ethical opportunism. Sure. And the other one is compassionate capitalism. We maintain our integrity, but those deals are coming. And so, in the past, it's been hard to find deals. That's going to change. It's going to be harder to find money, especially when the media is talking about how horrible real estate is, because that's coming. That's what they do. Their news isn't there to educate us or inform us. It's there to startle and scare us. Sure. And so, they'll paint it worse than it is, and they'll create fear around real estate. Sure. And there will be a lot of pain in the real estate markets for sure. Sure. But that is the time to pounce. When you can buy these properties at 20 to 30% of what they're at now, the exponential opportunities, I think it'll be a huge transfer of wealth, and possibly a once in a lifetime opportunity for those that didn't live through 08 and 9. Yep.
And that's where, I kind of keep going back, is that 08, gave us, the runway for, next, I think, 3 or 4 or 5 years. And you and I both know several operators who bought so many deals at the time are like, on the back of the yacht right now, So now, Rod, speaking of this, right? We are going through a current phase where, the rents can be choppy. Next few months will again.
The rents can be what?
The rent collections are absolutely choppy, basically. And, like the NOI will be varying moving forward, right? So, like, let's say when you're looking at some of these deals, right? How do you make sense of, what exactly the property is doing, or, what sort of tenant class is
going it's to be? A completely different, well, I shouldn't say completely different, but it's a much more enhanced evaluation process. Sure. For example, we take a hard look at the employment statistics around the tenant base. Sure. Are they recession resistant employment industries? And I learned this the hard way in 2008, because I had most of my tenants were either in retail or they were contractors, plumbers, electricians, drywallers, painters, roofers, you name it. And which all died in 2008 and 9. And so that was actually the coup de grace for my problem then. And it was the fact that nobody had any work. And so we looked at that very, very heavily. We look at, their, the where these people work. Okay. So that's number one. And the industries that support, or feed the demographic that's going to go in a particular asset that we're reviewing.
Sure.
And then we much more aggressive on our stress testing. So,
Sure.
we want to see an asset that will cash flow at about 65% of today's dollars. I mean, it's kind of a minimum now.
Sure.
And then the other thing we do is we have much bigger operating reserves than we normally would. We're not factoring in any rent increases for the next few years, 2 to 3 years, depending upon the asset. And so, just things that are quite a bit different than 6 months ago.
Sure.
Where everybody's got their 3 to 5% rent bumps. We never did 5%. Our 2 to 3 was always our thing. But again, with crisis comes opportunity, and it's not a time to be fearful. It's a time to be, it's a time to look for that opportunity. It's time to prepare for that opportunity. It's not a time to get sucked into the media, and it's really a time to manage our focus.
Sure.
If you're listening to Sakar here, you're a leader, and I'm going to tell you that right now the world needs leaders, and so to be the best leader you can be, you need to really stand guard at the door to your mind. Try to bring in as little of the baloney on the news as possible. Focus on what you want. Stay positive. On my podcast, I do these clips every week called Own Your Power, around mindset and psychology. And so even if multifamily is not your gig, I know you would enjoy those episodes to stay focused and motivated. And like this week's clip was on 100% ownership of your life, owning who you are. And they're only 5 to 6 minutes long. But the point is, the key here is whatever you focus on is going to get bigger, both positive and negative. So if you're focused on, all the COVID craziness, you're just going to continue to build that fear. It's unnecessary. Focus on the opportunities that are coming. Focus on building relationships with potential investors, pre-framing those relationships, and letting these investors know that, yes, it's going to look really ugly, and that's when we have to buy. So, letting them know, don't be fearful at that time. Get excited at that time. Warren Buffett's got a great quote around this, and I'm sure I'm going to butcher it, but something along like, when people are fearful, get excited. When people are excited, be fearful. As far as your investing criteria. Sure. And it's being a contrarian investor, but
be greedy when others are fearful, and
right. There you go. That's it. That's it. Right. So, but anyway, I don't know if I answered your question.
No, you did, Rod. Okay. And some nuances there, Rod, also is that as we move forward into next quarters, a few of the quarters, would you advise our listeners that we focus on perhaps mostly B-class assets, or do you would you advise like maybe?
I would avoid C assets, C- assets, only because I think that demographic's really going to get hurt. A lot of service industry people, but that I will tell you, there's some crystal ball with that. I will tell you, when things get really bad, people step down in, they'll go from an A asset to a B asset only to save money. They'll combine households. They'll do things that, so I could be all wet on that last statement. I don't know. Maybe people will go from B to C to save money. I don't know, but I know that, certainly a lot of retail is going to get hurt in what's coming. Restaurants, retail shops, things of that nature, gyms, things where people gather. I've got neighbors that own a couple of skating rinks, and they're in big trouble because nobody's taking their kids to a public place like that. And so, I think it's just really important to go deeper when you're evaluating an asset and get a list of from the seller or broker where those residents live and look at what feeds them.
Right. I totally agree with you. You know, the tenant profile is so important. So these are some of the nuances that I think we were not paying that much attention. We were, all good on, let's say what the income is and things like that. But now we have to go like one step further that, hey, what service industry are they working on? That's so
Right.
crucially important.
Right.
Now,
and how will it be impacted?
Sure.
And think about that. And I mean, you really have to consciously think, what's going to happen to that particular industry. Like I just read an article in Business Week around the companies that supply the automakers. They're getting killed right now. Okay. Sure. Because the car sales have flatlined. And so, you really want to dig a little deeper than you normally would when you're evaluating those employment industries as well.
Sure. And now, Rod, speaking of different markets and, growing states and things like that, would you maybe continue that much optimism around the Sun Belt states, or do you typically,
I think with all the stuff that's happened up north with this COVID business,
sure,
I think that migration south is going to be enhanced. Now,
awesome.
I used to tell people in Florida, 80 million baby boomers getting old and getting cold. That was my tagline.
Right.
And, and I was just a little early. That's all. I was a little ahead of the game. But I think even more so that the Sun Belt states are going to get a migration based on what's transpired here. This is just opinion. I'm not an expert in migratory demographics, but common sense tells me that the big problems were Northwest and Northeast with deaths and I mean, it was the deaths really the big thing. Right now, yeah, we've got all these infections, but let's look at what really matters, and that's how many people are dying. And I don't know what those statistics are, but I don't think they're quite as dramatic as CNN and some of these other media are portraying. But I know that there's still a lot of the northern states are locked down and it's just very cumbersome. Here in Florida, it's like business as usual, honestly, even though we've got supposedly a high incident of infections. I went to a restaurant last night, didn't have to wear a mask. It's just not a big deal, it seems. But anyway, yeah. So
now, speaking of just the typical asset class into multifamily, Rod, do you expect also this optimism and sort of all the things come up into let's say self-storage and other asset classes as well? That do you expect that we'll go into other things as well?
Yeah, my expertise is in multifamily and residential. That said, I have a pretty good foundation in retail as well.
Sure.
But as it relates to self-storage, I'm kind of a neophyte. I'll be honest. I've heard great things about that sector. I've never invested in it, other than to have erroneous garages in some of my assets, that we rented out, but never as a business. The asset classes that I like are multifamily. I like assisted living and senior housing as well. I mean, I think that tidal wave is coming. So that's an asset class I like. But I just don't know self-storage that well. I really think retail and office are going to get crushed. I think actually warehouse is also a positive, just with the whole Amazon dynamic and things being shipped more than normal. I think that the large warehouse space is probably good. Don't know much about industrial really, but there's my 2 cents on those different asset classes.
Got it.
Oh, mobile home parks, love them. I really think that that they are a great asset class as well. I've got friends. My brother owns a bunch of them.
Awesome.
My good friend Kevin Bupp owns a bunch. Yeah. So.
Sure. Now, also speaking of different returns within multifamily, Rod, do you expect any returns to perhaps change or modulate based on how you will?
You mean in existing assets that people have just that?
No, not existing assets. No.
You're talking about so when you were out there buying other assets, do you think that we're going to offer less return? Yes, it's very likely that we will. Yes, at least being conservative up front based on current numbers. But do I think that those returns will flip if assets are bought at 30, 40 cents on the dollar? Yes, sure. But, I know for us personally, we always do our best to massively underpromise and overdeliver. Okay.
Sure.
And And so, because that's how investors, want to do business with us. They don't want to be led down a path and not and have us not do anything that we don't say we're going to do.
Sure.
And so, and all operators should take that very, very seriously to under promise. And there's been a lot of over promising going on. So, if we find an asset, even if it's at 30 cents on the dollar, but it's 30 cents on the dollar because it's struggling with cash flow and whatnot, we will have very conservative projections. And because there's no telling how long it's going to take to turn around.
Sure.
We've never experienced this before, this type of a dynamic, because it's not caused by, the CMBS market where loan, if you could fog a mirror, you could borrow money. This is caused by, this has medical ramifications. And so
Sure.
we're in uncharted territory. So, I know as we move forward, we will be very, very conservative.
I see. Now, talking about broker relations, Rod, do you, are you doubling down on your broker relations now and,
no more than we were. I will tell you that we're getting a lot more phone calls from brokers than we ever did, because, brokers were the belle of the ball, but that dynamic is shifting more to a normal relationship. It used to be money went hard day one in some cases if the deal was good enough,
Sure.
And certainly greatly reduced due diligence periods. But now somebody's an idiot if they don't have COVID related clauses in their due diligence based on, on your ability to access a unit and access third party reports and things of that nature. And I think we're getting back to more of a normal due diligence cycle.
Sure.
I forgot what the question was or why I went there, but
the broker relations, basically.
Oh, broker relationships. Yeah. So they're normalizing where it's a give and take. It's not just trying to beat yourself to death to be in their Rolodex for off market pocket listings.
Sure.
But no, I think it would be a good time actually to enhance those relationships, because things are, I've got students that are frustrated because they I'm telling them, be careful right now. And they're not very patient. And so I'm telling them, to enhance their investor relationships, but you gave me an idea, and to tell them to double down. I think that's a great idea on their broker relationships as well.
Sure. And also, Rod, speaking of different value add strategies that go on into after we acquire the assets, have you maybe slowed down some of the value add improvements?
Yes. We've slowed down CapEx on some of our existing assets. You bet. Cash is king in a crisis. And so, we want lots of operating reserves on our assets, absolutely as much as possible. So yes, and there are a couple of instances where we've slowed down. We've a couple we're continuing forward with as well. We had one of our assets got destroyed by a tornado, and it's finally completely back online, and incredible success story there. But we've got another one that we've slowed it down a little bit, another one that we're moving forward on just from memory here. So it depends on the asset and the demographic and really how we feel about what's happening there, and our long-term, really even short-term and long-term thought process around the impact of a COVID-related contraction even further. So.
Sure. Now, speaking of, just the deal analysis in general, Rod, like let's say if a broker sends you a, OM, the operating memorandum, what couple of quick things you do to, kind of maybe sense that whether, the deal makes sense or not, or is this something you want to pursue? Could you maybe share some of your tips?
Well, I can tell you, I'll give you a real 50,000 foot criteria that we look for. Of course, we'll go in, we'll normalize the expenses quickly, make sure that the expenses we're getting are or have some basis in reality, and then we'll plug in anticipated debt, and then what we like to see, and this is kind of a high level, we like to see an annualized cash on cash return of over 10%. and even 12%, but 10% absolute minimum for a nice asset. Now this is over a 5-year period. So the first couple of years, if we're doing some CapEx, it might be 8, 7, 6, whatever, but it has to annualize at 10% or higher. And we're having discussions about bumping that up to 12. I like 12, but you know, Robert and I go back and forth on that a little bit, but you know, that's a very high level bellwether that we look at when we do some real rough and dirty numbers on an asset. You know, relying on, you know, maybe if it's a market that we're not that familiar with, you know, even in advance of doing our own rental analysis and whatnot, you know, we'll jump through. I mean, I'll be candid. Robert does more of that work. My partner, he's a CPA. He's done, you know, $1.5 billion worth of commercial real estate, and he does more of that initial analysis. I get involved when it's in the final stages and go visit and give it my common sense, put my common sense hat on and evaluate the final numbers that the team presents to me. But I will tell you that, you know, they become very good at it, and we used to kiss about 200 frogs to find a deal. And again, I think moving forward, it's not going to be as much about the deal as it is about the money. Right. Especially when the media starts scaring everybody to death and the stock market crashes. Because I will tell you, if you're listening and you've got money in the stock market, get out. Get out soon, because if you think it's going to continue to go up, you are extremely naive, respectfully. It's going to have a it's coming. It is coming. You can't have this many people out of work and not have it. And you know, people are like, oh God, we had high in the stock market again today. Yeah, well, just wait. Just wait.
True. And you know, speaking of you know, the returns as well, Rod, some syndicators like to you know, give preferred returns, you know, just to, you know, make sure the passive investors are kind of put in you know, ahead of the pack. Then there are other syndicators who kind of do no preferred return deals and do an even split. What are your thoughts? Like, because, you know, I have heard
it's very deal specific, Sakar, and there's so many ways to slice that deal up. You can do preferred return with a 90-10, 80-20, 70-30, 50-50. You can do no preferred return with a split. You can have a waterfall where you know, we've done that sometimes where it's a 70-30, you get 20% IRR and it goes to 50-50. You can cap the return. So it's really more like debts, 6% preferred. Once you get another 6%, that's it. Any money beyond that is return of capital. You know, there's just so many ways to structure a deal. It's very deal specific. It's very operator specific. It's, you know, it's the relationship that you've got with your investor base, how you present a deal. So it's all over the board, my friend. And it is also very deal specific, because sometimes you have to be a little more aggressive with your splitting to get the returns that you need for your investors, and maybe you have to take a little less as an operator. So it is really very subjective.
Sure. Now, a couple of housekeeping questions, Rod. You operate many businesses. You have the number one.
No, I have in the past. I don't have that many anymore. I have two businesses now. Okay. I have my thought leadership business, which is, you know, I've hundreds of students, and I do live events and the podcast and all of that.
That's still a massive undertaking to pull off, Rod. I mean, incredible. Can you maybe describe how you, you know, kind of arrange the back office of this? Do you have any lots of virtual assistants and all that? That'd be great.
You know, I will tell you, I've been thinking about doing an entrepreneurship podcast. I've been threatening it for 2 years. It's a topic. It's a topic I love talking about. Unfortunately, I'm going to bump up against a hard stop to get too deep into it. But I will tell you that I'm a big proponent of really having optics on the business. There's a book called The Rockefeller Habits, but even a more recent book that we've been following along with is a book called Traction, which implements the EOS system. And we've implemented that in my business, and it's been fantastic. We've loved it. But you know, a lot of those pieces came from the Rockefeller Habits. But the bottom line is yes, I have virtual assistants. I used to have 8 of them. Now I only have 2. But I've got a kick butt back office team. I've got, a content writer and videographer, and my daughter handles audio. I've got, I just hired a social media person to help with more social media engagement. I've got an incredible person that in the ops department that helps with the students.
Mm-hmm.
It's taken a while. We've kissed a few frogs to find this team, but we've got a kick butt team right now. And that's any business is nothing but people and systems.
Sure.
You need the systems, like the book E-Myth, Michael Gerber's book about McDonaldizing your business. You need to have systems, and then you just hire the best people you can possibly find. So, so that's a very high level response to your question.
Thank you, Rod. I appreciate your insights today. Please share with the listeners how they can find you and learn more about you.
I mean, if you're interested in multifamily, I've been doing 2-day live stream boot camps. When is this going to go live, Sakhar?
Probably just within 2 weeks.
Okay, fantastic. So July 25th and 26th, I'm going to have a 2-day boot camp, and I'm not selling anything, and it's $97. Well, it's actually $150 now, but if you use the code RODFRIEND, you can get in for $97, and it's 2 full days of me teaching, not selling anything.
Sure.
I'll have probably $1.5 billion or $2 billion in panelists represented by the panelists, and it's just soup to nuts, finding deals, evaluating deals, due diligence on deals, property management, on and on, every aspect of this business. So you go to multifamilyvirtualbootcamp.com, or you can text Rod Live to 41411. That's Rod Live, one word, to 41411, or go to multifamilyvirtualbootcamp.com. And if you have any interest in this business at all, you should come spend a couple days with me. I'd had 900 people that paid to attend the last one. I'm already pushing 600 now. I think we'll probably do quite a bit more than that. So, and people raved about it. Hundreds of people raved about it.
I can personally attest, Rod. I have been to your in-person boot camps as far as LA, Baltimore, and even Tampa too. So
wow.
I absolutely have loved, and in fact, I was also one of them in your last virtual boot camp as well.
Oh, thank you. So
it is an incredible value, and the amount of content that you offer, and frankly, someone can sit in their PJs from their house with their virtual,
right?
So it is. I mean, it can get better than that for sure. So,
Thank you. I appreciate that. So well, listen, it's nice to see you again, Sakhar, and good luck with everything. And I'm sure we'll talk again soon, my friend.
Absolutely. Thank you for coming on, Rod.
Right.
I greatly appreciate it.
Thanks for listening to Premium Cashflow Real Estate Investing Podcast. Please join us at premiumcashflow.com to sign up for weekly updates, research articles, and more. We will see you again for another great interview with an expert guest.